working, so I was just gonna look and see if it's showing up in the Facebook group. I can't tell if it is or not. Okay. Well, might have to go and do this the way I normally do, which is through Zoom, because I'm familiar with that, with that stuff and how it works in there. Okay. Okay. I am actually live. Okay, I see it. Okay, so hi everybody. Sorry about that. I am here to talk about in your successful even as you're starting up small. So I thought we would start with the basics, which is basically classification for your business. So most businesses off there are sole proprietorship. Wow, a sole proprietorship, which is basically you just start your business and you're collecting the funds. It's based off of your Social Security, and you typically don't have an EIN unless you have payroll. But typically you wouldn't, and it'd just be your Social Security. And then when you file taxes at the end of the year, it goes on something called a Schedule C, which basically is just a breakdown. It gets filed together with your personal. And then when you decide to maybe classify it as a business, you would get an EIN number with the IRS, and then in your state, you usually have to register your business in the state as well. And as a limited liability corporation and or company, limited liability company. And what that typically does when you have liability insurance is that it helps to see that it's in your business. So it really protects your personal assets. Anything if there was a case, small claims, or you were getting sued for something, that protects your business by creating an LLC. And then the other classification you could do is a partnership, which is basically an LLC, except there's more than one person. So that would be a partnership, and there's more than one member, or there's two or more members as part of this LLC, or this LLP is what it sometimes is also referred to. And then we have S Corps or C Corps. Now, generally, businesses don't file as a C Corp unless they're a bigger business, or if they're making a lot of money where they need to kind of mitigate some of those taxes. But that's really high level and typically isn't something that small businesses on the level we consider a small business would be at. And definitely probably not for most of the people that are on this call, because that's the purpose of this group, is to be able to support businesses that typically wouldn't get that support from accountants or bookkeepers because they can't afford those services quite yet. So the other classification then you can do with your business when you're first starting up is consider it a nonprofit. And what the difference is between a nonprofit versus a for-profit typically is that a nonprofit is tax exempt, and they are also mission-based versus profit-based or revenue-based. So you have to consider a few different things when it comes to nonprofits versus for-profit businesses. We are not going to get into that now, but I will do it because I know a lot of times people have questions about nonprofits and if they should set up or reset up their company to be a nonprofit, or if they should make an extension of their for-profit or nonprofit business be vice versa. So if they had a nonprofit, they should make part of it a for-profit, or vice versa, if they have a for-profit, if they should make part of it a nonprofit. But we will get into that in a different call. So today we are talking about the different classifications and how it impacts you tax-wise. So when you file as a sole prop or a single member LLC or a partnership, what happens is that when you get taxed at the end of the year, it is getting taxed on that whole net income, which is basically all of your income minus all of your expenses, and whatever that bottom line number is, that's the number that you get taxed on. And that's the number that you pay self-employment. File as a sole prop or a single member LLC or a partnership, you are paying something called the self-employment tax. Now, when you have a job and you work for an employer, you get Medicare withheld from your check. So you can look at your pay stub and see anything withheld. But what you might not know is that the company is actually matching that same amount. So it comes to about 15.3%. And that is the self-employment tax that you then pay on your taxes at the end of the year on that net income. Now, there's a benefit when you have a net income and you're paying towards your Social Security for when you retire. Then you have that money that you can then pull back or get back out. Hopefully, who knows, in the current level of things with government, but that's the idea, is that you would pay in and then you can take it back out once you start collecting security. And so that is good because you're in a way that you can save for retirement. And we're going to talk about that and all that special stuff on a different call as well. But today we are going to talk about how you might want to think about changing your classification with the IRS from an LLC to an S Corp. And what I mean by that, you can keep your business an LLC or an LLP or a limited liability company, but with the IRS, you would opt to be taxed as an S Corp. And the reason why that's beneficial, especially once you start making money, is that it is going to save you a portion of that self-employment tax that we just talked about. So that 15% is in addition to whatever your taxable income is. So if we had like a chart, lost my earbud. Okay, if we have a chart, you would have your income from W-2 sources, and then you would have your income from maybe retirement sources or interest, and then you would have your business income, and then whatever that bottom line number is your gross earnings. And then from there, you get to take out stuff like your standard deduction or your itemized deduction, and then the qualified business deduction, which is the thing that Trump added, which takes 20% of your net income, that bottom line number again, takes 20% and takes that off of that. So after you subtract out your standard deduction or your itemized deduction, the qualified business deduction, maybe a couple of other random things in there that most people don't take but are available, or not even take but are qualified for, but most people do not, especially depending on where you're at. But we can have further discussion with that if you need to. After you take that, that is your taxable income. And that's the number that you go back to the tax table with the IRS and you figure out how much tax is owed. So then you have this tax number that's there. And then on a top of that tax number is the self-employment tax. So that gets added after the tax is figured out. So you have your regular income and then that's added on top of that. So when you file as an S Corp, what happens is that you are then put on salary. So you have to pay yourself a salary, especially if you make decent income. That's one of the qualifications for an S Corp. But the benefit of it is that you could take whatever that net income number is and basically cut it in half. So half of it you would pay yourself salary and half of it you would pay withdrawals. And so instead of paying that whole 15% on the whole 100% net income amount, you're only paying it on half of that amount. Therefore, you actually end up saving yourself some money in taxes. So if you are making a decent amount of money and you tend to owe every year, this might be one really great way to cut your tax bill down. And this is definitely a conversation you should have with your accountant. Remember, I am here to help and be available to you. But this is a conversation that you should have with them because taxes, when it comes to your personal taxes, your business, regardless of if you file as an S Corp or a partnership or a single member LLC or a sole prop, the taxes have to go back on your personal taxes. So your business taxes usually in some type of way get filed with your personal taxes. Business taxes first, then personal taxes can get done. And so your personal tax situation is going to make a difference onto how this is going to affect your tax liability at the end of the year, which is why it's really good, important conversation to have with your tax accountant or somebody who knows what they're talking about when it comes to your taxes, but can also look at the whole picture when it comes to your personal and business side of things, because it can make a big impact. And being able to save taxes is always a great idea, right? But there are some additional costs that come with the S Corp. Usually it's a separate tax filing fee. Like I said, you have to have payroll, so you got to be able to pay for payroll costs if you want to have workman's comp or something like that, or unemployment insurance. you will have to have an additional amount towards that as well. So there's some additional costs to filing as an S Corp, which is why I typically recommend people to wait until their net income is around $50,000. So it varies for everybody, but that's usually when I'm like, okay, that's a decent amount. You can pay yourself like a salary from that, right? $50,000 hopefully is what you would be paying yourself in draws. But with an S Corp, then what you do is kind of split that. So then instead of you paying that whole 15% on the whole net income, you're only really paying it on half. So that's what I wanted to share with you today on Tip Tuesday. If there are any questions that you might have regarding classifying your business and what that looks like, I know we had a question regarding filing as an LLC. And when it comes to taxes, it doesn't really make a huge difference if you file as a sole prop versus an LLC. But what it does do is it helps to split that liability from your personal. It separates it. It separates the liability from your personal and your business, especially when you get liability insurance to kind of help with those risk and mitigate that risk amount. So that's definitely something that I recommend doing as a business grows, because you want to make sure that you're protecting your personal assets as well as your business assets. And so that's an important thing to do. So if you have any questions, please drop them in. And if you have another topic that you want to talk about, drop it in. If you know somebody that should be a part of accounting, your accounting sidekick, make sure you invite them, because we are going to grow this thing. We are going to grow your business. We're going to teach you how to keep more of your successful, because we are going to change the statistic that 8 out of 10 small businesses fail. Thanks for tuning in, and I will see you next time. Bye.